Welcome to our live trading webinar. It's live in a sense that I'm recording it live. There is going to be a recording, so if you do want to review any of this material later, what we'll do is I think we'll automatically send it out to you, and we'll also post it on our YouTube channel as well. So hopefully you get it. What we're going to be discussing today. Before I get into that, just keep in mind that any advice contained in this presentation is general only, so it's not tailored to your personal circumstances, and you need to decide for yourself as to whether it's appropriate to you. So in today's webcast, as I was going through before, I'll touch on who we are. Some of you will obviously know who we are, but for those of you who don't, it's good to get an idea as to what type of business we're about, and the ethics of the company, and what we strive to do basically, and why we exist. We'll talk about what we think the most important things are that you need to focus on in order to be a successful trader. We'll go through some trading rules. We'll go through some market analysis. I'll give you, hopefully, if I have time, an example of a real trade that we kind of did today. And then I'll talk about some of the education that we provide towards the end as well. So if you're on tonight, there's a good chance you're probably at the beginning of your trading journey, so to speak. You're probably in that research phase where you're watching YouTube videos, you're attending webcasts like this, you're reading ebooks, you perhaps bought a book, and you're really trying to tackle what essentially is a really big, broad, complex topic, right? Because if you're on TikTok or YouTube, if you kind of hit any of that mainstream social media, there's a lot of people obviously spruiking trading, right? It's usually typically stuff out of the US, out of places where regulation is less strict, where they can kind of, I don't want to say lie, but they can certainly over embellish a lot more and make very grandiose profits and talk about, not profits, grandiose promises about profits and things like that. And certainly we're not like that. Hopefully you'll kind of get that feel from us throughout this webcast. And you're just trying to suss out, if you're local here in Australia, we obviously, or perhaps New Zealand or something like that, for a provider of education or someone facilitate your trading. So I just want to run through who we are first and just give you an idea as to kind of what our principles are. We're a boutique trading company, so we're a small business. There's about 8 of us in the office. We've got a very horizontal management system. So myself and pretty much the rest of us drive the ship, right? It's not a very horizontal management structure that you would maybe typically see in the finance industry. We have a full-fledged trading desk. That ultimately means we have a platform that people say, that means you can trade through us, right? We provide online execution. So we provide our client software and they can trade through it. And or you can pick up the phone, speak to me directly or one of my colleagues, and you can place your order with us and we can execute it for you. We like to say that our business model is hopefully built on mutual success, because our idea is that if we can teach you the right things and support you the right way and give you the right advice, then that's going to put you in a better chance to become a successful trader. So we don't want to trade for you, but we want to put you in a position where you can discover your own risk tolerances and your own style that works for you, and provide a very strong support mechanism as well as the resources around that to help you succeed. If you are successful and you make money from the market, then you're likely to continue to trade through our trading desk and use our services, and that's what keeps our doors open. So education for us, even though it's something that we do, isn't typically a profit center. It's not something that we really make money from. We kind of break even on it. It's just a stepping stone, really. We don't want to be an education company that sells education and then moves on to the next customer, or sells education and has this kind of continuous approach of upselling and upselling and upselling and upselling. The reason our doors stay open is largely because of our trading desk and the relationships we have with our long-term clients. And we just look at education as a way to get you there, really. We're also very big on community support and resources. It's easier said than done, but ultimately there's probably a couple of main ways that we support our community in a broad sense. So, for example, most days that the market's open, we run kind of live trading webinars during the day. So, for example, today, I ran my webcast from 12 p.m. to 1 p.m. And during that webcast, old clients jump on, new clients jump on. Mine's a little bit more education focused because I help create some of the education content, and I believe that's a part of the skills that I have and that I bring to the business. But certainly what we do often, and as well as the other advisors in their own webcasts, is we go through the market and we look for trades, essentially. It's a good opportunity to get advice from the group on a position that you're in. It's good advice to get an opinion on a particular stock that you're looking at. But also it's a way to kind of create a sense of community in what would otherwise be a lonely pursuit, right? We also run a message board where we post trade ideas. We put market updates, the webcasts that we run, and some like key market data releases. Like today we had GDP, for example, where we posted the GDP release as well as a quick analysis of it. Otherwise, the way that we support our trading community mainly is through a one-on-one basis. So we provide full service advice when it comes to short-term trading, as well as obviously longer-term investment. But obviously, short-term trading is probably why you guys are on, or at least it should be, because that's where a lot of people come to us for. What we do is we trade mainly the Australian market, but we can certainly facilitate overseas market trading as well if you're interested in trading the US at night, or Indian market, or Canadian market, or the UK market, whatever it is. But the scope of our education and the majority of our trading, or what our clients trade, is honestly the Australian market, and that's mainly because it's our backyard. We know these companies, like people know CBA and BHP, and it's simply open when we're awake, right? But if you have the penchant for overseas markets, and that's something that we can facilitate as well. Our advice can be revolved around helping you analyze the stock, helping you price up a strategy in a position, and helping you execute that order. So putting the trade in the market if you want us to, or closing you out, or whatever it is. So a lot of very high level advice on short-term trading. And when you are trading, even myself, it's always good to kind of lean over and just get a second opinion, see if you've forgotten something, or if what you're doing kind of makes sense. On the peripherals, we also provide other online resources like fundamental data and research, in-house quantitative and qualitative scoring as well for investment research, provide market updates, and as well as all the technology we use, like the trading software that you'll see me use tonight, the calculators, payoff matrices, trade planners, stuff like that, so you can train your plate effectively before getting in. All right, I appreciate you sitting through that. Hopefully you've got a better idea as to what our company is about. Now, getting into the kind of guts of the presentation. If you've got any questions, like I said to the people who arrived early, please feel free to type them in as well as any remarks that you might have, or if there's anything you want me to look at specifically. All right, this is water, by the way, not vodka. So the foundations of a successful trader, and I think this is kind of what we advertise this webcast tonight as. I just want to kind of cut out all the fluff. I know I just kind of started with fluff, but when it comes to the actual guts of the presentation, regardless of who you get educated through, whether it be us or whether it be someone else, there's three main areas that we think you should focus your efforts. So again, if you're someone who's relatively new and you're in the midst of your kind of research phase, there's a lot of stuff that you can look at, right? I guess the point of tonight is to kind of help you focus that, right? So we believe that if you want to be a successful trader, you need to be good at really three things. You need to be good at picking direction, you need to be good at strategy, and you need to be good at risk management. Now, obviously that's easier said than done, right? And it's a long journey to be good at all those three things. But at least you can now know where exactly you need to focus your efforts. What kind of brings all of that together is a set of trading rules, right? Trading rules are particularly important for beginners, and they probably remain as equally as important for several years after you begin. Trading rules are a way to basically take all that information that's out there, right? You've got fundamental stuff like CPI, interest rates. You've got news from your mainstream news sources like the Financial Review or the AFR or Bloomberg. You've got a lot of pundits out there like Wolf of Wall Street types. You've got a lot of politics going on, left versus right, and how that kind of can affect the markets as well. There's a lot going on, right? There's a lot of information out there, a lot of different types of analysis. what you really I guess what a set of trading rules does is it kind of helps you turn all that stuff and process it through a bit of a meat grinder, and allows you to kind of lay it out in a step-by-step approach, if that makes sense. And it also helps you filter out to a large degree, but not completely, what you should be what you should be seeing as noise and what you should be seeing as important, kind of cutting through the grease, so to speak. So trading rules keep you disciplined. That's really important as a beginner because, and it's important for the first while. I myself am still not disciplined sometimes. It's always actually easier to give advice on someone else's trade than it is to take my own advice on my own positions. A lot of the time we're kind of in the way of ourselves. Trading rules kind of help alleviate that. They help keep you on track. They certainly can help reduce stress because if you kind of have faith in the process, then it can help keep your nerves down a little bit because you kind of have a process to follow. It helps certainly simplify decisions. Obviously, you have faith in the rules because in theory they're logical and they've been tested. Obviously, they're not always going to work, and there's times where you're going to find the rules need to be tweaked or adjusted depending on what the market conditions are like, how your risk tolerances evolve, the styles and strategies that are you're favoring at the moment that you're finding success in. So it's not perfect, but in theory they should be logical and tested. And as I said in the beginning, it helps alleviate emotional decision making, which I got to tell you is pretty much the ultimate goal. Now, when it comes to technical analysis versus fundamental analysis, we mainly focus on technical analysis as our preferred method of picking short-term direction. Fundamental analysis is more for medium to longer term investing. We find that the health of companies are more likely to play out over a longer period of time than price action during the shorter term. So what I mean by that is that fundamental analysis is like reading the company balance sheet, looking at PE ratios, comparing that company to its neighbor in the same field, and then looking at whether or not that's undervalued holistically or not, right? That plays out in the longer term, we feel. Technical analysis is more about reading past price action. It's about reading price action that's happened over the past year to 6 months to 4 weeks to 4 days to 4 minutes, right? It's about looking at the chart essentially and using a bunch of principles in order to paint a picture and form a short-term view. Now, that's not to suggest that you should necessarily use one over the other, but you certainly would put more weight in one over the other, right? Fundamentals still play a role in our decision-making. That's certainly true. But whenever we put out a trade recommendation or whenever I'm giving advice to a client on their position, it is certainly technical analysis forward, right? Now, technical analysis is, like I said, just one part of the puzzle. That's more about picking direction. And you want to have a set of trading rules that help you go through that, right? So, for example, the first part of your rule should be around trend and bar analysis, right? You're looking at entry signals. The second part of that rule system should be probably around support and resistance levels, trends and counter trends. And then the final piece of that puzzle should be about identifying patterns and looking at technical indicators, right? Now, you can kind of mix all that up if you want. You can rearrange it. It doesn't, whatever, Trevor. But those are kind of the main principles that you need to have trading rules built around. When it comes to strategy is more about planning the trade effectively so that the type of strategy that you're entering is focused on what your view of the technicals are, basically, right? So I'll go into that a little bit more later. What I just said will make a bit more sense further into the webcast. And then finally, you obviously want to make sure that you have good risk management systems in place, right? And good capital management systems in place. It's actually really not uncommon to have someone who's coming through our course doing actually really quite well on the direction picking side and the strategy side as well. But they kind of fall apart at the risk side because the risk is where the emotions really come into it. It's like super easy to enter a trade, right? Well, I shouldn't say it's super easy, but decision-making isn't as kind of stressful as closing out a trade. So my colleague Sam, some of you would have spoken to, he always says that the hardest thing you'll do is close a trade, right? because if you're in a profit, you want more, and if you're in a loss, you want to stop that loss, right? And so risk management, is something that people struggle with in the beginning. So it makes sense to have some kind of rules there that help alleviate that stress and just kind of give you a process on when to exit and how to plan that effectively. So I'm just going to jump back to technical analysis and kind of give you an idea as to what our rules-based system looks like. It's not going to be exact because our rule system can be a little bit more complicated. And obviously, I don't want to give away, the secret sauce straight away, but it'll give you a pretty good base in which you can kind of start learning and start mimicking if you want. So what you see on my screen is a chart of the XGO. I took that this morning before market open, so it is missing today's bar. I just wanted to kind of build some slides before the market opened. It looks pretty, I would say to some of you that chart looks kind of messy. To others, it doesn't look messy enough. My chart doesn't really get much more crazy than that. I'm missing maybe a couple of lines, but that's about it. Certainly, there's other types of analysis that I might overlay. I might look at Fibonacci's or something like that for those of you who've got some background in this. But that's about as complicated as my chart typically gets. As another example, that's the US market as of last night. You can see, somewhat similar, right? Lots of stuff going on. Hopefully by the end of this webcast, you'll have a better understanding as to what's going on there. So when it comes to technical analysis, the first thing that typically you want to try and do is just identify nice and easily what the trend is, right? I mean, this is pretty bare bones basic stuff. Okay, so you might recognize that quite simply the stock was down here and now it's up here. It was down there, now it's up there. So it's uptrending, right? I don't think that's rocket science. What this uptrend line here is doing is it's acting as support for the stock. So when the stock retreats back to the line that I've drawn in, it seems to bounce higher, right? So it gives you confidence that the next time it returned around these days here, you might feel comfortable entering a bullish trade. Now, again, it doesn't take a genius to say that if a stock is trending up, then doing bearish trades probably has a higher chance of succeeding, right? Now, obviously, there's times where that's not true. And obviously, the trend is your friend until it's not, because trends change. But generally speaking, trading with the trend is going to put you in a better position than trying to snipe counter trend trades. The other thing that you can do, if it's relevant, is try and define what the market range is. Our market loves to be range bound, the XGO in particular. So if you can identify what the trading range is, then by all means draw the line in, but don't try to make it work. If there's not a market range there that you can clearly identify, don't stress. That's fine. The next thing that you want to do is kind of identify what your key levels of resistance and support is. And what I'm doing right now, by the way, these lines that I'm drawing on my page, even though they're simplistic, this is the groundwork for technical analysis, right? This is like the structure of the building. The rest of it is kind of decoration in some ways to kind of personalize it. This stuff here, even though it's simplistic, is honestly just the groundwork. And this is stuff that you need to get good at. Now, the next thing that you want to identify now that I've drawn my resistance in, and you might go, well, why did you draw that resistance in? Is because you can see when the stock has gotten up to this point here, it's pulled back. When it's gotten up there, it's pulled back. And when it got up there, it tried to peek its head through, but then pulled back, right? So that resistance level has played a strong effect, has had a strong effect on the stock. It's suppressed it. It's, as the name would describe, it has resisted against the stock from rising on 3 different accounts. Okay. The next step would be to identify any patterns and or breakouts, right? So one simple pattern is called an ascending triangle. This is technical analysis 101, but it's very important. Ascending triangle is an uptrend line, as you can see here. where the stock is consistently bouncing higher from that line, right? And a key level of resistance. I personally think that the resistance should have at least 2 or 3 touch points. So one touch point there, one touch point there, and one touch point there. So that's 3 touch points during the life of the trend for it to be considered a valid ascending triangle. Okay. I want to see the stock being squeezed like a spring. So it's going up, bounce, bounce, and then it hits that resistance and pulls back, hits it again. You can see how it's being squeezed. It's no longer making higher peaks. So that pattern there is a triangle pattern. We just call it an ascending triangle because obviously it references the uptrend. The next step is to identify any kind of breakouts. So as you can see historically here, it's pulled back every time it's gone to that resistance, but this time round, it's actually pushed through. So the stock has got some momentum behind it in a sense that that resistance is no longer in play as a resistance anyway. It might be a support later down the line, right? So this tells us that the stock is no longer ready, is no longer going to be held back. You know, the chains have been broken. You know, it's got its freedom and it's ready to continue higher, right? Typically, and there's a bunch of different exit signals that you can look at. I'm just going to go with a very basic entry signal, right? Oops, sorry, I jumped too far. An entry signal can be stuff like a breakout. It can be a candlestick pattern like a morning star or evening star. It can be the break of a neckline off a double bottom or double top. You know, there's a lot of different types of entry signals. I'm not going to go into all of them tonight. This is just a classic breakout of an ascending triangle. It's also the share price is near the top of the trading range, where the open is near the bottom of the trading range. And again, that kind of denotes momentum behind share price movement. Once you've identified the entry signals, so the next step would be to confirm with indicators. So indicators are like mathematical algorithms that are typically expressed as graphs, is how I would put it. Yeah, that seems right. So this is called the stochastic oscillators, and there's a few different ways you can use them, but in a very basic way, it can help show momentum. So when the blue line, in this case it's blue, is spreading apart from the red line when it's like opening up, that indicates momentum as well. This is typically a lagging indicator, by the way. You can use it for divergence as well, which you would. And in this case, you could as well, but I won't go into that. And we just use it as a confirmation tool. All right, so you'll notice that my analysis has gone in a specific way. We started off with looking at trends and counter trends. We then looked at support and resistance levels. We then looked at entry signal, patterns and breakouts. And then we looked at entry signals, right? Now, you can probably switch all that stuff around if you want. You could start with entry signals. You could start with support and resistance. You could do that. You could do that if you wanted. But your technical indicator should always be put at the end of your analysis. Because this chart looks kind of cool, it looks like, you know, some kind of sophisticated algorithm that tells you the secret to pick the direction of the stock. Inexperienced people who are just starting out, they lean on this stuff too much. Because it looks kind of like, I honestly believe it's because it's almost like a cheating way of looking at a stock. Not a cheat, like a shortcut. I'm trying to articulate something that's difficult to articulate. But yeah, people often use technical indicators in a way, they lean on them too much, right? So we put them at the end of our analysis, and that's pretty good advice if you're just starting out. Don't lean on your indicators too much. The other indicator that I like to use personally is the 50, 100, and 200-day moving averages. This is pretty stock standard stuff, right? This is not anything. There's not like some silver bullet. Again, there's no silver bullets in trading. If you come across a company that talks about like some secret method, or a company that like boasts a lot of profits or like big profits, they should be like massive red flags for you, like massive red flags for you. Okay. There ain't no free lunches in this market. there isn't a way to make money from this market without putting in effort, learning, and being consistent. There just isn't, right? Now, I should say there probably isn't, right? I certainly haven't come across any, and ones that I've looked into are all scams. So the moving averages, getting back to the point, is not, again, not some silver bullet or anything like that. They're just a confirmation tool. In this instance, what we can see is that the 50-day moving average is acting as a support level, right? Every time the stock in this particular circumstance has returned to the 50-day moving average, it's bounced higher. So that reinforces this idea of entering a bullish trade, because not only have I seen the stock bounce off the uptrend line, I've also seen it bounce off the 50-day moving average, right? There's other ways you can use moving average. Like, for example, the 50-day crossing over the 200 is a bullish sign for the medium term, not for the short term, but for the medium term. It's called a golden cross, I believe. All right. Yeah, there's other ways you can use moving averages, but this is just a good example of what this chart is showing us, right? So if I was just to quickly recap, we're looking at trend and range, looking at support and resistance, looking at patterns and breakouts, looking at entry signals, we're confirming with our indicators, and then really at the end, we can consider our fundamentals if we want to. Typically you would, obviously. The reason why we wouldn't suggest that to beginners is because you're adding too much, right? You can get something called analysis paralysis. It's also why I've kept some of my indicators off, like the Bollinger Bands aren't there. I haven't done other types of technical analysis, because at the end of the day, your education needs to be a step-by-step approach. If you try to add too much on, including fundamentals all over the same time, you might find that you never trade, or each trade that you enter, you're not going to be very confident on, because you'll have conflicting indicators, right? So you can consider your fundamentals. Yesterday, I spoke to someone who wanted to go long on Qantas. I suggested just be careful, because Qantas is in the news at the moment. There's the allegations about Qatar Airlines. There's the allegations, that the CEO stepped down. So maybe watch out. Someone wanted to trade Fortescue the other day, and I said, well, 3 executives have left in 3 weeks, so there might be something going on there. So maybe just leave that stock alone, right? Fundamentals for me can often be more of a warning sign about avoiding a stock, because at the end of the day, 90% of my analysis is on technicals. So why would I trade a stock that's moving fundamentally? There's so many different stocks you can trade. Why pick one that's moving fundamentally? If that's what your analysis is and that's what you're forming your trade opinion on, by all means. But if your rules-based system is focused on technical analysis, why would you trade a stock that's moving fundamentally, right? Now, hopefully that was a good kind of coverage of a rules-based approach, right, to technical analysis. And it'll give you a bit of a place to start. Next, what we're going to do is we're going to talk about strategy, right? And strategy is fairly simple. So strategy is a way to trade your view, basically. And as traders, we like to trade different instruments in order to be able to trade different market conditions, right? And the reason for that is twofold. One, we want regular trading opportunities. So we need to be able to trade bearish markets. We need to be able to trade sideways markets. And it's ideal to be able to access leverage so that we can use less money while still making a good dollar profit, or it translates to us keeping a lot of our powder dry if we need to. So we trade different instruments because we want regular trading opportunities and we want leverage. And the other reason is because by being able to trade different market conditions, you start to look at stocks with less bias. So if your only trading strategy is to buy the stock when it's low and then sell it when it's high, then the only type of trade that you're ever looking for is a bullish trade. And that's what your filter is going to be when you do your analysis. Because in the back of your mind, you're going to be hoping there's a bullish trade, right? Whereas if you have strategies that allow you to trade from bearish movement as well as sideways movement, then you don't care what the stock's doing. You don't care if it's going up. You don't care if it's going down. You don't care if it's going sideways. You just want to be able to apply your technical analysis to arrive at a decision, basically. So having different trading strategies, in my opinion, makes you less biased, right? It gives you different tools to use for different jobs, right? You don't use a hammer for everything, right? And it also gives you access to leverage, which I think is important. There's two types of instruments that we like to trade mainly, and they're mini warrants and their options. Now, this is all traded with the underlying security being stock. So I look at BHP every day, I look at CBA every day, I look at STO every day, I look at Wesfarmers every day, Coles, AGL, Mineral Resources, Flight Center, whatever, right? I'll probably look at about 200 different stocks every day, right? Maybe not 200. Sometimes I do. So we are talking about the stock market here, but the instrument that we're trading on them is called a derivative, which ultimately means that the value of that instrument is derived off the share price movement. So if I buy a derivative such as a mini warrant on CBA and CBA goes up or down, the value of my warrant also goes up or down. It just goes up or down more rapidly if I want it to, right? Which is essentially what leverage is. Okay, so hopefully that kind of makes sense. Now, mini warrants are great for beginners, in my opinion. I wouldn't go out there and try to self-educate short-term trading as it is. Yeah, I don't think that's a good idea. That'd be like teaching yourself how to drive a car. It's doable. You're just probably going to get a few dings if you, and you know, or worse, right? But as a beginner, I also wouldn't try to self-teach yourself derivatives. I wouldn't try and teach yourself options or warrants as a beginner, especially whilst you're trying to learn technical analysis and while you're trying to learn risk management as well. So, but if you come to education with us, obviously we put you in a progressive learning environment. You know, you have your own personal trainer. You know, obviously there's a lot of resources we provide, and you know, we get you to do several months of paper trading, all that type of stuff. So we teach mini warrants to beginners because in a structured environment, we think they're actually fantastic. We think they're, honestly, we think they're great. We think that any kind of intermediate trader should know how to trade these. And I'm super surprised there isn't more, what's the word? You know, ASX marketing on it. Like the ASX is a private well, it's a public listed company that trades on itself, which is funny. I don't know why they don't promote warrants because I think they're pretty user-friendly. You trade them through the exchange, so you trade them through the ASX or like Chai or something like that, which makes them transparent and regulated. That's very important. You should only trade things that are regulated and transparent. For you crypto bros out there, good luck. And that's all I'll say. They're very, like I said, beginner-friendly. They have very limited choices of leverage. Okay, so it's not like as if it's got this kind of overwhelming complexity to them. So you've got a handful of choices of leverage. They're capped risk, so you can't lose more than what you pay to enter. So like what I mean by that is, let's say you buy $1,000 worth of Wesfarmers shares, and Wesfarmers dies, you know, turns out the whole thing was a Ponzi scheme and it does an Enron and the share price goes to zero. The most you can lose from that trade is $1,000 because that's what you paid when you entered the trade. That's how many shares you bought. Your shares are worth nothing. You've lost everything, but it's only $1,000, right? That's what you call a capped risk. Warrants are the same. You have a capped risk on warrants. You can never lose more than what you pay to enter. That's really important to us. They actually have inbuilt stops. So if the trade goes against you enough, you'll be automatically closed out of the trade. That's a good thing and a bad thing. It takes away some control over your own positions, but it's also a bit of a fail-safe. So if something goes wrong, you know, you'll automatically be closed out. If something goes like wrong quickly without you noticing or whatever it is, which shouldn't happen, by the way, but if it does, you've kind of got that safety net. You can use warrants to profit from a bullish trade, and you can use them to profit from a bearish trade. So if you're a retail trader like me, and I am going to safely assume that pretty much all of you are considered mum and pop retail traders, right? Don't take offense to that. It's true, even if some of you are sophisticated. I personally think, and it's just an opinion, that warrants are probably a better way to short stock than shorting stock, right? Shorting stock can be very expensive, and you know, from what I've been told by other people who've done it, it can cost a lot of money. Warrants offer a way to profit from a bearish trade for pretty much anyone online. Like if you guys are already trading and you have like an account with ComSec, you can trade warrants. You don't need to be particularly sophisticated or anything like that. So as you can probably tell, I'm a big believer in them. That being said, because they are a derivative, and I'll reinforce this, don't try to teach yourself how to trade them in the beginning. Obviously, get some experience first if you're going to go down the path of self-education, because you are dealing with leverage and you are dealing with a more sophisticated product than stock. Am I looking for time? I think I'm over-explaining stuff, going a bit too slow. So the other type of instruments we like to trade are options. I'm not going to go too much into this because I don't want to get too complicated, but options are the most flexible instrument that you can trade on the Australian market. I wouldn't be surprised if they're the most flexible instrument you can trade on any market. I wouldn't know that for a fact, but I would, if I was a betting man, I'd bet that is the case. Now, what I mean by the most flexible, in a sense that you can trade a whole bunch of different types of trades. You could enter a position where you profit from a bearish movement. You can enter a position where you profit from a bearish movement and sideways movement. You can enter a position where you profit from a bullish movement or a bearish movement if it's large enough, which we like to do around reporting seasons. They just offer a severe, like a huge amount of flexibility in both in both the direction in which you can profit from, but also the choices of leverage that you have. You can really fine tune your strategy to suit your trading view. Options is certainly something that I wouldn't suggest someone tries to teach themselves. This is just a quick example of leverage, right? So this is how essentially, this is a rough example of how it works. Let's say the current share price is $32, right? Of Wesfarmers. I know it's not, but let's just say, let's say Wesfarmers is trading at $32. There might be a mini that I could buy for $3. So the share price is $32. The mini on Wesfarmers, the mini warrant on Wesfarmers is $3, right? So you can already see that you can buy, if you had 10 grand, you could buy a whole lot more minis than you could Wesfarmers shares, right? Or if you had 5 grand, you could buy a whole lot more minis at $3 than you could Wesfarmers shares. The thing is, the mini moves 1-for-1 with the share price. If the share price goes up 50 cents, so does the value of the share price, as I just said, but so does the value of the mini, right? If the share price goes up $1, then so does the value of the mini. But can you see where the leverage is? Can you see where I'm going with this? If you make 50 cents, if you buy the stock at $32 and it goes up to $32.50, you make 50 cents, right? Which is 1.56%. If you buy the mini, which is $3, and the share price goes up 50 cents, you still also make 50 cents, except that's 16% profit. If the share price goes up $1, that's 3.12% if you were to buy the shares, or 33% if you had bought the mini, right? Because your mini goes from being worth $3 to being worth $4, right? Which is a 33% jump. However, that also translates to the loss side of things. So if you buy Wesfarmers shares and the share price drops $1, that's all right. You've only lost 3%, no stress. But if you buy the warrant and it drops $1, you've just lost 33% of your money. So you need to respect leverage. Okay. Now, not every, what do you call it? Not every option, or sorry, not option, not every warrant is as leveraged as this. Some are far less leveraged. So the warrant might cost $15 and it's only 50% leveraged. Or there might be a little bit more leverage. That's about as leveraged, yeah, maybe a little bit more leveraged. Yeah. So you have choice. You can plan your trade effectively. All right. What I want to do is I want to share my screen. So this is what my trading software looks like. That, by the way, that's what our market did today. It came off a little bit. We're still kind of in this trading range, but we stuck our head below it. And we've moved right back to the comfort of these moving averages. right? The 50, 100, and 200 day. So we'll obviously be looking overseas to see how the US trades, right? This is what the US market's doing. You can see that they're consolidating as well and trading somewhat in a bit of a range. So just drawing that support there. All right, but enough about the market. So what we got here? These are the minis that we've done recently. I wanted to kind of show you minis first. I didn't really want to go into options, but I'll show you maybe, yeah, I'll probably just stick to warrants, but we put our trade recommendations on both. So these are the last few mini warrant recommendations that we've done. So we did ARB back on, you guys see this all right? Is it like zoomed in enough? We did ARB on the 24th of July, so over a month ago. I can't remember how much profit we made. I think it was about 24%, 25%. I can't remember. Usually we would have it written there. I might be able to find it. No, that's not what I'm looking for. These are options recommendations. And you can see where the dates are. So that was April. That's these are single leg options, just calls and puts. So you can see we don't do single leg options very often. Yeah, this is our spreads that we do more frequently. So we did that 5 days ago. We took a 24% profit. We did A2 milk, a straight put. We took 45% profit. We did it on the 31st, so about a week ago. We did a Rio bull call on the 23rd and took a 26% profit. But in terms of single legs, you can make more money. So like we took 134% profit on this AMC put back in April. But you can see we don't do them very often, right? We're more likely to do spreads. I was going to go through an option recommendation, but I'm probably not. I'm just going to stick to minis because I think they're simpler. And I'm running out of time. So when we put out a trade reco, what we do is we go through our rules. We explain why we like the trade, and we put a chart up. This chart is fairly basic. We don't like to clutter up our charts when we put them out. If you call up, we can do screen shares. We can send you screenshots. But yeah, ultimately, we want to keep things fairly clean. We priced up the strategy in our payoff matrix, and told you where we're looking to take profit and where we're looking to take loss, give our stop loss out. We've still got a QBE trade open, and this BPT one's still open. Yeah, the NTM, I think we closed. Anyway. So what I'm going to do is I'll show you how we kind of do that, right? So we obviously write up some words, we take a screenshot, but this is the payoff matrix that we like to use. Now, we put out a bearish trade today on Westpac, and you can see, like a good celebrity chef, I have my chart already prepared. Oh no, what's going on here? All right. So zooming out, you could do some broader analysis on Westpac if you want, but the stock's largely just going sideways. I mean, it has been since for the past 2, maybe 3 years, right? The whole market's like that. If I'll just show you what I mean, and we like it. There's a strategy that we use on a weekly basis that makes money from sideways movement. So we don't mind the market tracking sideways. In the context of Westpac, we put out a bearish trade today. The reason is because we've got nice bearish entry signals here. You can see it's following this downtrend line. It broke the counter trend, so it broke out of what you call a pennant pattern. It cleared that support level here, and the next key level is probably back down here, so there's plenty of room there, right? The Bollinger Bands indicate volatility, so volatility starting to widen. It's coming out of the overbought area of the stochastics and pointing down and spreading open. again, indicating more volatility. So this is a pretty kind of stock standard bearish trade. Now, on two big bearish days like this, it's not uncommon to see some retracement. So if the stock's up tomorrow, which I wouldn't be surprised there was a bit of early morning buying, don't be like, aha, you know, but yeah, it's not uncommon to see stocks go up and down whilst they trend, right? It's totally normal. Like throughout this period, there's times where the stock doesn't do anything, right? So what we decided to do was we did a calendar bear put, which is an options trade. But rather than go through that, I thought I would try and translate that a little bit to a mini warrant. So, and again, you got like, today was the day to enter, but you know, if it opens fairly flat tomorrow, you know, you could go and do this if you want, right? Keep in mind that any advice contained is general only, all right? It's not tailored to your personal circumstances. I've probably been on this page for too long, so I'm just going to refresh. So yeah, if it does price up well, you could probably go and buy this through whatever broker you're already trading, if you're trading at the moment. Probably, I don't know. So what was the share price of Westpac? We'll call it 21.19. Okay, these are the longs, so they profit as the stock goes up. And these are the shorts, and so they profit when the stock goes down. You can see that this column shows where the stop loss trigger level is. So if the share price reaches, for this mini warrant, if the share price reaches this level, automatically closes the trade. If the share price for this warrant reaches $24, automatically closes the trade, right? So typically when I'm pricing this up, I'd like to get a stop loss that's above where I would use my own technical stop. So I would probably use this support, this resistance level, sorry, as a technical stop, which is about 21.70. So I'd want to put I would want to make sure the inbuilt stop is above my own technical stop, so that I'm not kicked out of the trade early before I want to be kicked out of the trade, right? So I'm looking for an inbuilt stop above 21.70. So that would be, you know, either of these two, $22, right? I should be out before the share price reaches $22. In fairness, though, that, hang on, let me have a look. Yeah, I should be out before the share price reaches $22 because that's like up here. Thing is, that mini might not actually be trading, and I have no way of checking because the market's not open. So maybe I'll pick this one, the $23 one, WBC KOX. The bid and the ask can be mathematically calculated, so our calculator does it. It's $4. It'd be $4.55 to $4.57. The bid would be $4.55, and the ask would be $4.57. I know that mathematically because the value of the bid and the ask is derived off the share price being $21.19, right? If I was to trade that to $21.20, the bid and the ask should change by 1 cent, roughly, right? Okay. Now that I've got the warrant that I want to trade, I'm going to go down WBC KOX. What was the price again? $4.55 to $4.57. Just take the middle of those two. And now you've got to figure out how much risk you want to do. So if one mini costs $4.56 and you buy 100 of them, then your risk is $456. How much you risk is your business, not mine. I'm just going to put, I don't know, oops. $10 grand, let's just say $5 grand, 4,500, right? So this is a payoff matrix. Now I'm going to zoom out a little bit to see if I can fit it all on the screen because I've zoomed in my screen. Hopefully you guys, that's not too small. So that's the current share price, 21.18, roughly, right? 21.19, but anyway, it doesn't matter. Close enough. And this number here, 21.39, is 1% higher in share price. That's 2% higher in share price. That's 3% higher in share price. And you guessed it, that's 4% higher in share price. That's $20.96 is 1% lower in share price. $20.75 is 2% lower in share price, and so on and so forth, right? Now, that's today's date, the 6th of September. That's 2 days' time, the 8th of September. That's 4 days' time, the 10th of September. All right, you get the picture? So what this allows me to do is it allows me to track my profit and loss over time, but also at different price increments. Now, when I say profit and loss, I mean profit and loss, right? This is not what the trade is worth. It's how much money you make when the share price goes up, or how much money you make when the share price goes down, based on your entry price and based on your risk amount. Okay? So I said the next support was probably back down here at $20.80. And you might say, why is that? And it's because it will support back here, right? Probably the next key level, though, is probably down here. It's just that both have been support in the past. This level has been support through here, and this level has been support through here and here. So it's somewhere down there, right? So I'll be conservative and say, okay, well, if I want to take profit, I'd ideally like to be able to make good money by the time the share price reaches $20.80. Now, with this mini, you can see that if the share price gets down to $20.75, right? So close enough to $20.80, I'm probably going to make about 9% profits. This is percentage terms, 9% profit, right? If I want, I can look at it in dollar values. Probably looking at about $400 profit. So if the share price drops 2%, you're making 9% profit. That's the leverage, right? It means that you can risk less money, ultimately. But it also means you can lose more money, right? You understand that. If you can make 9% with a 2% fall, then that also means you can lose 9% with a 2% rally, right? Now, is 9% enough profit? That's a decision that you need to make. That's a decision that you need to make. This is where your own risk tolerances come in. Okay? Some people would be very happy with that. Now, what about a stop loss? So let's say the share price gets to 21.70, roughly, let's say 21.70. If it goes through 21.70, how much am I going to get hammered? In percentage terms, I'm probably going to lose about, by the time I get out, probably about 10 to 15%, something like that. It depends how quickly I can close. If I use these levels here as a resistance level, if I use these levels as a point to stop out of the trade, now ideally I'd probably want to use a higher level as well, but that's my own risk tolerance. As long as you have a plan, that's what matters. Because I might actually choose to use $22, right? I might be happy to actually kind of lose about 25% of the capital, right, in order to hold this trade and see if it can hold this level of resistance as well as a downtrend line. That's typically what I would do. But you might want to be a bit more conservative and close the trade if it goes through, 21.70, in which case you would have to be willing to lose 10 to 15%, right? So there's no right answers here. I guess what's important is that you have a plan and that you plan your trades effectively, right? That's what's fundamentally important. Where you take your profits should fall in line with support levels, right? So you might suggest that you want to take your profit here, or you might suggest that you want to take your profit there. You might think that you want to use this resistance level as a stop out. Or you might say, no, I've got a bigger risk appetite. I'm going to use this level up here as a stop out. I don't really mind. It's horses for courses. If you come and do education with us, we'll give you some structure around that. But ultimately, over time, your own risk tolerances will filter into your own trading, right? And that's healthy. as long as it's an active decision, not an absent-minded one. Okay. I hope that all kind of makes sense. If there's any any questions, type them in, and I will go through it. All right, I'm going to quickly run through the type of education that we have. As I mentioned, a lot of you are probably in this phase here where you're just beginning to start out. Hopefully I've given you some places that you recognize now where you need to focus your efforts, right? Hopefully I've given you kind of a bit of a leap pad so that when you go and watch your YouTube videos and you read your books and stuff like that, you've got an idea as to what you should be focusing on. The next step is obviously to practice, learn and practice, and then finally, obviously, to gain experience. When it comes to our own education, we're very big on face-to-face, or if you can't come down to Melbourne, do a live stream. So we've obviously got students in New Zealand and other places. WA is as far away as New Zealand, right? And so we've got international clients, and we've got people who, even in our own countries, very far away. So live stream is a good solution to that. During COVID, obviously, we weren't allowed to have anyone face-to-face, so we figured out a pretty rock-solid solution there. So we believe in face-to-face education. We believe in online learning. We believe in one-on-one mentorship. We believe in group skills, group learning as well. And we believe in a very practical and structured approach. So there's other courses out there that, they kind of advertise themselves as more diplomas from like Singapore and stuff like that. And you could certainly go do a university degree, but you're going to find that there's a lot of information in there that isn't immediately practical to becoming a trader, in my opinion, right? I could be wrong. I haven't done those courses, in fairness. But if there was more that we wanted to teach you, then we would, ultimately. And if you're trading through us, the education kind of always continues and you'll always pick up stuff. But during our 4-month course, we mainly focus on exactly what you need to know so we can get you up and running, essentially. So we mainly focus on the core skills and refinement. If you come along and do our 4-month masterclass course, the focus will be on technical analysis, trading strategies, risk management, trading rules, and you don't need to have any experience. You can be a complete beginner if you come along to this course. In fact, if you're kind of worried about your level of education, we actually have a pre-learning course that brings you up to speed, that has some quizzes that'll make you feel comfortable about your level of knowledge before you even come along and start this course. In this particular 4-month course, we've got 2 weekend workshops that we spend together. We do it here in our boardroom, so you get to come in and see this wonderful office. We're really happy with it. Actually used to be an apartment, lots of wood furnishings. It's very nice. But you just come along and do it in our boardroom. We only take in 10 students in doing each course. So we think that's a good number because it's a good group environment, a good group dynamic. And we think that's important. We want to put you around other like-minded people. But 10's also small enough that you can't get lost in the crowd, right? It also means we can tailor the learning experience towards you as an individual as well, right? And try to focus on what your needs are from a learning perspective. During that 4-month course, you also have 4 months of online training, right? We assign you your own trainer as well, your own mentor, and that's where they're there to work with you one-on-one, essentially. So they're there to look over your shoulder. I'll go through that in a moment. But yeah, we try to cover all our bases. We have face-to-face learning, we have online learning, we provide your own trainer, we provide you with manuals and training videos. So we try to kind of cover all our bases for different ways that people like to learn. In terms of your own mentor, as I was going through earlier, each of the trainers here have plenty of years of experience. Like, for example, I've been with the business for over a decade, I think, something like that. And I'm probably the average level of experience in the room, right? Each of your mentors is also a trader. They're also an advisor and obviously an educator, right? So if I'm not helping one of my students, I'm helping one of my traders, right? So you're learning from someone who, is in the trenches every day, basically. They're there to answer all your questions. So you can call your trainer as many times a day as you like. In fact, we encourage it. The people who engage with their trainer the most tend to be the ones who have the best chance of being successful. Certainly all of our successful traders, as far as I'm aware at least, engaged with their trainer quite a lot. Makes sense, doesn't it? Your trainer's there to help turn the knowledge that you grab from online learning and from the face-to-face weekends into practical experience, okay? And then once you're ready, once you've proven to yourself on paper first that you can turn a profit, your mentor's there to help you transition to trading with real money. Now, if you're interested in doing this course, it's a total investment of $3,495. That includes the 2 weekend workshops that we do here in our boardroom. It includes 4 months of online training where you have access to our online learning portal. You have your own dedicated mentor, 4 months of trade recommendations, as well as all the technology we use. So the calculator you just saw me use, we have another calculator for options trading. You'll have access to the software that you saw me use for charting functionality, so that you can obviously look for trades and do online execution. So basically, you get all that for $3,495. That price is going up for the course that we have in December. The next course that we're running is actually on the 16th and 17th of September. That's the first weekend. If you're interested in the course, you'd have to be available for that weekend, as well as the 4th and 5th of November. You would have to be available for that weekend. So those 2 weekends are part of the next course that we have. Otherwise, we've got a course starting in December that'll carry over into the new year. Now, if you're not interested in education, fair enough. If you're just looking for someone to trade through, we have a great trading platform. Our software's decent, but where we really shine is through phone support. So there's heaps of stuff that we provide our clients. We can also do reporting for you for your accountant. We can do full reconciliations, all that kind of peripheral stuff. But yeah, if you're kind of a big trader and you're looking for someone to get advice off to check your positions, there's probably more knowledge on options trading specifically in this office than anywhere else in Australia, or any other office in Australia, I should say. We certainly know what we're doing. We certainly have tenure. So if you wanted someone to kind of back you up in your trading, you're welcome to explore the idea of opening up a trading account. All right, I'm going to finish up there. I've actually done pretty well. We've gone for pretty much an hour. I know I spoke really quickly. In the past, I've like waffled on for like an hour and a half. So I didn't want to do that this time around. If you've got any questions, type them in now. I'll leave the chat open for about another minute, I reckon. And then I'll finish up. But otherwise, I'm happy to answer any questions over the phone. If you guys want to give me a call and speak to me directly, that's totally fine. If you call through, there's a chance I pick up anyway. Again, we're a boutique trading company and there's about only 8 of us in the office. You can trade index options. We trade, one of the last trades we did was on the XJO. So give me a sec. Thanks, Rob. We did, when did we do a put? We entered a bear put, an option strategy this day here. And we closed down here and we took, again, 20 to 30% profit. I couldn't tell you exactly. In fact, yes, I can. And I can tell you. Yeah, XJO bear put. We took 24%. So you can trade on the index. That's fine. We do it regularly. In fact, one of the strategies that we do a lot on the XJO is giant condors, basically. If you know what that means. Minimal. There is no minimum. There's no minimum. We don't have a minimum. We're not trading for you, right? So we're not like a. Even though we do have a managed fund portfolio, obviously that's not the topic of tonight. When it comes to short-term trading, we're not trading for you, to be clear. So there's no minimum. If you want to put a $1,000 trade on or a $100,000 trade on, as long as you've got the capital, we're happy to facilitate it. Any other questions? Can we trade index options with 1,000 Australian dollars? Yes. Like for this For the bear put that we did, I can't remember what we suggested as a minimum. The minimum we suggested was about $3.5 grand for that trade as a minimum. But if you'd called up and said, I only want to put $1,000 on, I would help you price up a strategy that would be adequate for that. Like for this A2 milk trade, I know it's not the XJO, but just as an example, the recommended risk, the recommended minimum risk when we did the trade, when we put out the trade recommendation, was about $1,200–1,300. But that's just a suggestion. You can put however much risk on the trade that you want. It's up to you. In fact, we really encourage you to make your own decisions and discover what your own risk tolerances are. A lot of the 4-month course is about putting you in, I would say, a safer and progressive learning environment, right? Where you're able to explore what works for you and what doesn't, and what type of risk tolerances you have, right? So if you wanted to do that extra bear put, you might say, well, Karo, I don't want to do a $3.5 grand risk. And I'd be like, okay, well, that's fine. What we'll do is we'll reprice the strategy and how much risk do you want to do? And if you said, well, I only want to put $1,000 on, then I would try, and I couldn't guarantee, but I would try and rejig the strategy to suit that type of payoff. If you came to me and said, I want to put 50 grand on, then I would probably suggest rejigging the trade as well, right? I hope that kind of makes sense. All right, I might finish up there. I hope you guys enjoyed it. I haven't run one of these in like a month or 2 months or something. So if I was a bit rusty, I apologize, but I think it flowed fairly well. We got to cover what we wanted to cover. We talked about trading rules. We talked about technical analysis and gave you an approach there. Gave you an idea of different strategies that we like to employ, and a little bit about risk management as well. And we got to look at and price up a strategy, price up a trade, give you a bit of a trade idea. So hopefully you guys enjoyed that. It'll be posted on the YouTube page, I hope, and it should be sent to you via an email. If any of you are interested in the course, just before you leave, type in like info or something. Just let me know, basically, and I'll make sure that the course brochure gets sent to you as well. Awesome. Well, it was good seeing a lot of you on. Thanks for joining, for all you familiar faces. And thank you guys for, anyone who's new, welcome. And I hope you enjoyed it. Thanks, guys.